Welcome, everyone, to a new episode of The Money Movement. I'm joined here today with Eric Glyman, who's the co-founder and CEO of Ramp, a high-growth, high-profile fintech focused on reinventing how businesses, startups, growth companies bank on the internet. Something that's obviously near and dear to our heart at Circle as well. Really pleased to have you on here, Eric.
Thanks for the invitation. Great to see you, Jeremy.
Yeah, excellent. Lots of stuff I was hoping to chat with you about today. I thought maybe we could just start with some of the basics, which are really, really helpful for people, which maybe just take a couple of minutes. Mission, vision of Ramp. Where are you on that journey? And then we're going to connect the dots into some other stuff too.
That sounds great. Look, I'll start with, what is Ramp here for? And I think it's sort of this notion of every company has a purpose. We serve thousands of companies, whether they're working on improving the healthcare system, making humanity multiplanetary. Our mission as a company is to save companies their most valuable resources. It's their time and it's their capital, so they can build better, stronger, more efficient businesses. And the way we do that is by creating finance automation tools. And so we're known and power the fastest growing corporate card in the US. It's a corporate card that has built-in spend controls and tools to help the average company spend less money. We also offer bill payments, expense management, accounting automation. And the net effect is that when you use a Ramp card or Ramp payments in general, we're able to help the average company cut their spend by about 3.3% per year. So more dollars back to get used in the core company's purpose. We help speed up accounting and month-end close. And so we help the average company close their books about 5 days faster each month. And overall, our focus is really trying to build tools that are so useful that whether you're a startup founder operating a finance teams at a large company or a small, you're able to really automate really the menial and the low value parts of your job and focus on high value, just growing your company. So that's a bit about us, but happy to go deeper.
Yeah, awesome. So I want to come back to a bunch of themes there in a little bit. I think one of the other big topics I wanted to talk about, maybe we'll move into that, and then we'll come back to sort of the fundamentals of Ramp's business. Is you guys made waves recently with a blog post that you put out. Which was then I think covered in Forbes or Fortune or whatever, basically about how you had looked at your own balance sheet and you had analyzed all the different ways that you could use your capital, and your research led you to look at stablecoins, in particular, USDC and sort of stablecoin yields in USDC as a really important way for you as a treasurer, I guess not you, your treasurer, your CFO and treasurer, to manage capital. Obviously, full disclosure, right? We're working with you on that, and you're a customer of Circle and Circle Yield and everything else. But I'd love to hear your high level take on that, and then I have some follow-up questions.
Yeah, of course. So a couple of things. I mean, just first with obviously the lion's share and where we focus most capital for businesses really on the core operations, but in making sure that we have a just robust a lot of capital for whether it's good days, rainy days, all that. We always want to have capital on the side and in excess. It's our job to be thinking about, one, how do we be responsible to investors, but also two, how do we invest capital in a prudent manner? And I think the reality facing many companies right now is it doesn't feel so great to have just a lot of capital earning basis points every year. And so given that some of the capital that we had on our balance sheet was not going to be used for many months, in some cases many years, given the financial planning that we were doing, we wanted to look and see were there more compelling ways to both increase yield on our balance sheet and balance against that risk. And stablecoins were immediately jumped out as incredibly fascinating in that, given just the volatility in crypto markets, it's created a world where the volatility itself is a yield producing assets, and tied to stablecoins actually could present a way to, one, effectively hold cash or cash-like assets on the balance sheet. So low risk in profile, and also collateralized securitized. There are a lot of things that made Circle's product particularly interesting for us. But yielding materially higher. And what jumped out pretty immediately was with just a small percentage of our balance sheet, single-digit percentages, we could earn as much yield as the next 95, 98%. And that was fascinating. So it was pretty arresting, and it's something that, sometimes I think the corporate treasury, family is stuck in tradition so much so it actually misses some of the interesting things happening in the world. So cool to be early in this.
Yeah, absolutely. I mean, I think a while ago, obviously, like Elon Musk, Tesla bought some Bitcoin, whatever, that these kinds of things, or Square bought some Bitcoin, and so I think there was a little bit, a year ago, where people were saying, "Oh, corporations, corporate treasurers, they're all going to buy Bitcoin." Right. That's everyone should have whatever it is, 2% of their corporate balance sheet in Bitcoin or whatever. And obviously a treasurer or CFO of any business, right, is trying to think about capital preservation. Obviously we've seen, these huge moves up, huge moves down. Right now we're at a 50% decline, et cetera. And so most CFOs, whether you're a small business or a growth company or a larger business, like that's pretty gut wrenching for your working capital, right? To do that, but steady state, 5, 6, 7% dollar based yield is a lot more attractive as well. But I mean, I'm interested if do you think, given what your experience is and what you guys are learning, do you think this is something that more and more, maybe it starts with sort of technology-oriented companies where there's just a better understanding of technology and how it works, as opposed to, say, a treasurer of, say, I don't know, an oil and gas company, I don't know what, but do you think that this is going to be something that just becomes a more common tool for businesses?
Definitely. I think there were a lot of interesting questions that were that were in that. So first, I just think at Ramp we have a fairly vested interest in trying to understand how are people moving money, storing money, and a lot of our goal is helping people get more out of every dollar. Can a dollar feel like $1.05 to a customer through technologies? There's a lot of the driving focus for us, and we were seeing it even in our customer base. Of course, there's many traditional companies, but we serve, whether it's large crypto companies in their general operations, crypto exchanges, in their corporate spending. And so we felt like, look, it's as more and more companies are not just spending in fiat currency, but in cryptocurrency, we can't not learn about this and also have this firsthand experience. And so part of our focus early on was just how do we start to get exposure, and also take things really seriously as a business and get into it. And I think even the act and exercise of learning about it has been great, and not just producing yield, but even in making sure that the company is well positioned to learn about it. And I think it's fascinating in that, like, look, in many ways, at least for me, and I'm curious if you think about it too, Jeremy, but like it feels in many ways like early internet, where all the direct applications of how things are going to be used are going to take years to figure out, but it's clear there's something there. And so I think that for many companies, if you think that future operations, may intersect with, the crypto Web3 worlds, actually holding some on your balance sheet, you think about it more. You learn more about it and follow along. And I think that just, from creating a value for a business in the future, it actually can be quite high.
Totally.
Yeah.
I mean, there's lots of good analogies with the earlier evolutions in the internet, but putting some stablecoin yield on your balance sheet is the proverbial toe in the water. And it's kind of like, whatever businesses were like, okay, we have to have a website. We have to at least put something up there, like who we are, and maybe a little bit of, it's like the brochureware was the kind of concept back then, but it's there. And now you're saying, okay, what are other people doing? And oh, wait a minute, we could actually, people could put a customer support request in through the web, or wait a minute, we could sell our products through there, or our product is the website, or whatever, sort of goes on. And I think crypto is similar, right? As businesses begin to dabble in this, and we've actually had a theory that that kind of this sort of corporate treasury side of things, and basically dabbling in yield and so on, it's sort of exactly what you said, just like a gateway to be learning about it operationally. All of a sudden you're transacting in a stable coin. You're like, wow, this is actually pretty powerful, as opposed to an ACH or a bank wire or a traditional card transaction. And so it sort of leads people to look at the operational side of it as well. And so from kind of treasury capital to working capital to payments, right? You can kind of see how a lot of this stuff can definitely evolve.
Totally. And I think that's exactly it. Like there's some businesses for whom, I think that for most businesses holding, Bitcoin on the balance sheet, might be, diving right into it and taking on kind of a few variables at once. But I think you're exactly right. Stablecoin is this really interesting first step, where in many ways it's very familiar. It's a dollar. It's tied to it. You're not taking on. Most people don't have experience with foreign exchange and forex and even other fiat currencies, let alone cryptocurrencies. And you start to hold these different variables concept, and you start to, I think, see actually. There's something different and unique, and you can start getting things where one, the obvious of, okay, there's higher yield back into dollars. I can do this. This is great. And so it's a better use of capital. But I think you're right. You also get these other side effects if you see how easy and simple it is to move funds in this manner, to track, to get, instant settlement, other attributes, which are, turns out really useful in lots of other use cases. But I think it is kind of this very interesting gateway that I actually think that many people, if they were kind of thinking in a clear-eyed manner about their businesses, would be using more, and I think, frankly, should be using more. I
mean, I think we're very aligned with you on the sense of how do we return capital to productive use in businesses, right? Which is, there's these implicit levies that exist on businesses, which are all these costs. They can come from a lot of different places, but within the financial system, there's all these embedded costs, and can internet native services, internet native software, and actually now with crypto, right, internet native protocols, bring the same kinds of unit economic efficiency and kind of the 10x improvement in product experience that you get out of internet services. Can that finally arrive in the financial realm, which maybe ties a little bit back to your core mission as you described it. And I'm interested in hearing, as you've been at this for a number of years as well, which is, Fintech, I think, for a long time has sort of been, kind of innovating on top of a whole set of existing kind of infrastructure, right? So the traditional core banking infrastructure, the traditional, dollar settlement infrastructure, card rails, and there's a lot of innovation to be had in just making those just easier to use and have better tooling around them. And I think you guys have done an amazing job, just getting out ahead of that. And I'm interested in your take on, do you feel like, does crypto represent sort of, deep tech in fintech, right? There's sort of like deep tech in certain categories. Like, is it kind of going to a deeper level versus kind of innovating at the kind of automation, user experience, and data level, which is, I think, a lot of what we've seen to date from fintech?
Yeah, I think your analogy is quite good, and I think it lines up with how many people perceive it, which is like, I do think that a lot of the crypto scene does feel like deep tech, but what's interesting about it is because you're able to re-architect and get away from frankly just poor in some cases design decisions, things that are crazy of like, yep, on weekends, like no money movement. Despite businesses increasingly, it's happening from armchairs, desks at home, things over the weekends, like paradigms that don't totally hit. And so in a way, I do think it's deep tech, but because it's rebuilding the building blocks, it's showing up in a strange way, and even things like productivity use cases and interfaces that I do think there's going to be a lot more innovation, and we're seeing it even over the past 6 months, year versus the past years, that's speeding up. But I do think that in general, the APIification and the abstraction away of even traditional finance layers to become interfaces you can interact with is actually setting this off. And in our space, we have an interesting purview to this, because like my last company was bought prior to starting Ramp, was bought by Capital One, and so we got to see up close like how at what many consider to be the most kind of tech forward of the banks, how did it look? And I learned things that shocked me from that I know since, of things that like core processing of credit card transactions did not happen at Capital One. It happened at a third party provider. It's almost, for a developer, imagine if you wanted to write code and you had to, instead of being able to access AWS, you had to phone it in.
Yeah, no, totally. Someone else. And at the bottom of that stack are FTP servers and common delimited text files.
Completely right. Maybe, and there were still COBOL developers that I met. It's nuts what's going on. And I guess what I would say is that I think one of the most interesting that's happening, at least in traditional finance, and something that we're very passionate about, is I think that many large banks and also many traditional finance service providers don't think about, is they fundamentally don't think about your time. They've been around for hundreds of years. Their founders might have died 100 years ago. They're taking bank holidays off. And I think part of the reason why Ramp grew so quickly was not just that we built software interfaces that are easier to use and save you money, but that it would save people time. If you can really build interfaces that are intuitive, match to people's workflows, you can get the best out of fast and efficient financial settlement. But if you can make work easier and allow people to do higher order, more productive stuff, that's actually where I think new battle lines are getting drawn, and why I think fintech has accelerated in many ways. So there's obviously a lot of breadth to it.
It touches so much the like sort of fundamental infrastructure changes, and as described, like some of that's happening just by just building better software and leveraging data on top of kind of what is underneath still god awful. Some of it's like replacing the god awful with something more modern, like digital currency or whatever. And then there's like this continuous cycle of like automation and user experience and just driving that. One of the ideas that we talk a lot about is the idea of programmable money. And and that's a concept that I think is pretty core to crypto as well. And when I started Circle, almost 9 years ago, the thing that got me into it was this idea of programmable money. And by way of background, like I started my career building developer tools and programming languages and app infrastructure and app servers and like all this sort of stuff for the web, and like had been building software platforms for a long time and around media and content and data. And so the idea that you could actually have like money is a native data type on the internet, and then it's programmable with smart contracts, was just really, really mind-blowing to me. It was like, okay, you could actually have programmable money. And that's different than like the API-ification or like open banking or, Plaid, this abstraction layer to like kind of get at this or that or whatever. And it sounds like for you, as you think about Ramp, this sort of automating more things in the financial landscape of businesses is at the core, right? In some ways, it's like automating these things is about returning capital and time. And I'd be interested in, when you think about what would be, when you think about the target area of corporate, commercial and corporate finance, what's worth programming? What's worth automating? What can you unlock? Like, what are the things that would really make a difference in the velocity that businesses have?
Yep. All of it. It would be my trite answer, but truly, like, I mean, company, like, what are companies anyway? What actually are they other than, organized systems to produce something, hopefully, in a pure financial sense, to produce returns. It's the notion that if you bring people, time, money, resources together, you can go and do this. And I think that one of the, for many companies, for listeners, you're working at a company, a lot of people who are, and I think a lot of people identify and resonate with the movie Office Space, with just, things are so inefficient because that's often how it is. And I think that, for me, if you can both automate and program money, but even automate a lot of the workflow that goes with it, that's where the really interesting stuff goes on. And so, for example, I'll give you one interesting quirk from the corporate card world. And expense management world is the IRS, put out this rule that if you want to take a deduction for an expense over in general, you need to have proof of it. And if it's an expense over $75, you need to have a receipt. So that one rule means that whether you're a company with 50,000 people, a small startup, it is set across literally what is every year millions of man hours, productive hours being spent just collecting receipts, tagging it to the right transaction, closing the books, making sure if an auditor were to open the books or the IRS, you could actually go and uniquely find it. And it turns out it's just for, to collect data that existed in the first place somewhere. And so a lot of, when we think about even programmable money and interfaces, one of the small things that Ramp does is we actually, started to automate that process through. So the second that a transaction is triggered, we authorize a transaction above $75. If it's in person, a card present, we can text the cardholder, pull in Twilio, get a service. The user can take a photo, send it back. If it's an online purchase, we can trigger an email, they can forward an email. Can integrate with Gmail and actually, say we don't even need a person to this in the first place. A transaction is authorized. Let's pull from the inbox and see, is there a new transaction from this merchant? Pull it on through, automatically close it. And I actually think whether it's programming money or programming the other workflows around it, that's where really interesting magic happens. And you say, get rid of this crap, actually, build your business instead of be wasteful on all the ancillary stuff that should be automated away. And so I think whether it's programming or just automation, there's so much value to create there.
Yeah, absolutely. In blockchain land, we dream of a world of all of this, all these transactions being on chain, all of the, the quote unquote audit trail is basically, perfectly viewable and you sort of get to kind of the shared state of money and the recording of that and the reconciliation of that becoming a lot easier. I'm interested, in maybe changing gears a little bit, in how much of what you guys do is working with startups and growth companies and sort of the appetite for startups and growth companies for just fundamentally changing the kinds of tools and services that they use we see that in SaaS, and if you're a startup, you're just all SaaS products and stuff like that. Just interested in that, and how much of that is a driver for you guys.
So it's a really good question. I actually think that for most, I'll put it this way: like the orientation of most of our customers is they've got some business. They happen to have to need credit cards. They happen to have to need expense management, accounting automation. But in many ways, in like the focus and brunt of what they're trying to do, it's incidental. It's a thing that they need to use and to cope with. And I think that a lot of for us, what's made and how we orient the services is something that it feels very familiar. A credit card, expense management, you might know accounting before. And so in many ways you can substitute this out. But once you get into the service, you start seeing there's so much more behind it that's automating, that's showing you things that you didn't expect, and go for it. And so I actually think that, at least in selling to companies, making it feel much more familiar and less foreign is actually a big it's a big asset. Like often people don't come in and say, I came to ramp.com because I'm looking for finance automation. They say, I'm looking for, corporate card, automate some stuff for me, help me spend less, all that. And I like in many ways, I think it's part of why as a first crypto product, we were so attracted and interested in stablecoin, in that it's like, oh, I know this. This is these are dollars on the balance sheet. We already have dollars on the balance sheet. We're substituting with dollars on the balance sheet, but behind it was actually so much more interesting and sophisticated. And I think in many ways, a lot of the products that grow most at extreme rates are really like that. There's an element of familiarity. It fits into something you already know, you already love, but then behind it can actually evolve products rapidly. And so these gateway products, or these products that are really radical beneath but familiar, take a form factor that got too lazy. I mean, the credit card was a perfect example of this. Like, the most credit cards that people use are the same cards that people's parents did. Hasn't evolved in 30 plus years, and it can do so much more if you can, take it. So we try to think a lot in those terms.
Totally. Yeah, we think of USDC as sort of dollars with the superpowers of the internet, and it's like, well, what does that mean? Well, the internet's got a lot of really powerful capabilities, and you bring dollars to that. That's awesome. I guess a higher level question too, which is a little bit on a little bit of where you see the world going, which is there's sort of a little bit of the view that, if you look at commercial banking today, right, it's still like dominated by, Chase and Wells Fargo and Bank of America and, just the biggest, commercial and, just integrated mega banks, right? The mega banks have all this sort of stuff. And there's obviously like the commodity products, which are sort of business banking products. And then there's like corporate finance. And as you kind of move up the curve, like there's all these things that happen for businesses. And when you think about the TAM for Ramp, and you think about, those companies, you don't have to name names, but like, those kinds of companies, do you think this is a world where in 5 to 10 years, like similar to the share shift that happened in media and communications and retail with the internet, do you think that that's the kind of share shift that will happen, going from the traditional financial market utilities into more internet native financial market utilities that are, built from the ground up in the ways that you're building Ramp, or that Circle's building what we're doing, or other things like that? What do you think that looks like? Is that because at a high level, right, I go out and talk to investors as well. And I think, we think the TAM is extraordinary. It's a many multi-trillion-dollar TAM, right? How do you think about it? How do you think about that space? And without getting into like, details of your product roadmap, just sort of, do you see companies like Ramp occupying more and more of the verbs of finance for what needs to be done to sort of grow?
I do, and I'll give you a couple of frameworks that we try to use to think about this, and also like what's the relative speed that you can sort of expect on this. So one, I just think that we've been in sort of a very interesting moment of time, where in many ways, prior to the past 5-10 years, I think there's a few things in the conditions of the market. You really couldn't enter this market. Like in many ways, like my past employer, Capital One, was an anomaly. Rich Fairbank, who runs it, is alive and well. His closest competitors, James Pierpont Morgan, died at the turn of the century, like 100 years ago. American Express was started in 1850. And that window really closed on it. And so I think in financial services, a lot of it is one, what's your cost of capital, what yield can you create, how secure is this? And it's a business that historically where scale has really mattered. And I think that we've just entered a period over the past 10 years, and I think that we're very much in it, where new competition can start to come in. And I think there's a few reasons for it. One, I think some of the, at least in the card world and also in neobank world, regulation coming out of the financial crisis, regulators not wanting banks to be too big to fail, to prop up smaller banks, effectively incentivize small banks who had a bank charter to work with different and modern providers. So you didn't have to be a bank to start creating bank-like services. The cost of interest dropped dramatically, which basically means that the long-standing advantage of banks, which is extreme low cost of capital, wasn't just with banks. You could go out and you could borrow if you could access this low yield environment, coupled with technological innovations, whether it's Bitcoin, cryptocurrency, whether it's infrastructure players like Marqeta and Stripe or Plaid or the like. Suddenly you could start to go and access into the core building blocks of storage of money, assessment of risk, creation of payment vehicles, low enough cost of capital that actually, even if you were just starting out, you had a focus, you could start to go. Now, the conditions were there. How do you build something that moves a lot faster? And I think when we were starting, we were trying to think through, is like, okay, like these companies, even though they have a lot of issues, are quite good at something. American Express, which many folks sort of see as our kind of nearest traditional large competitor, or us to them, was extraordinary at marketing and brand. I truly think they have one of the best brands of all time. And so we thought, okay, if we're going to compete with them, it can't just be on the basis of great marketing, cool celebrities, great points. Like we should get smoked. Chase, amazing distribution. Capital One, amazing ability to assess risk. And so we said, what's going to be different about us? And we felt that one of the truly the weaknesses in this, that none were designed for fast iteration. This product and engineering led culture, and so let's make speed and ability to iterate quickly be really quick, both in the products that we're developing, but also too in trying to identify where the traditional finance let people down. One of the first ones was, back to that IRS rule. Let's take that and run with it. This was true of basically any Amex transaction that companies were doing. Amex never thought about it. They said, we're in the points business. We're in the brand business. We're going to leave the rest of it to Concur, to Expensify, to aftermarket providers. And that meant that for every company, they needed to use two sets of software to do one thing. And they needed to plug into a third software, which was to accounting. How can we build product that wraps around that so it starts to save people lots of time? And the question is, okay, are you operating in finance? Are you operating in expense management? Are you operating in accounting automation? Are you operating in broader B2B payments? That our fastest growing product today is in payments that traditionally, Bill.com, banks, ACH transactions.
Yeah.
That's been growing, in excess of 100% per month, and in 2021, and we're seeing that rate coming into this year, and it's this interesting exercise where suddenly, if this approach of fast speed is extending into all this, do you actually start adding the TAMs? Is it something different? Can you actually, in the same way, I think you're seeing this with cryptocurrency use cases you never imagined suddenly emerge. What can you do there? So it's all to say, I do think the TAMs will be much larger. I do think that there's going to be some enduring advantages that large banks will have, but I do think that, like the music industry, where some traditional folks reinvented themselves and became great, but also there are some modern players that really took things on. It's very much happening in fintech right now, and may happen even faster than I think is possible. You might be more right on the leading edge of the speed that this is going to happen.
Yeah, I mean, I think there's something about when sort of internet scaling hits certain things, and I mean, I think we've been floored just with like USDC. It's growing at a staggering rate, and as blockchains get more accessible and scalable and usable, right? Just the unlocks that kind of start happening are pretty remarkable. But one more kind of high level question for you, which is a big part of kind of the competitive advantage of fintechs, and if you ask Jamie Dimon or people like Jamie Dimon, or the ABA or Bank Policy Institute or any of the significant lobbying firms, I think there's this kind of concept that it's an unfair playing field, that fintechs are not regulated with the same constraints, and so they have an unfair advantage. They rely on other banks, and can kind of do things that traditional banks can't, and that's clearly true, right, at some level, right? But I guess it sort of begs like a higher question, which is, at the end of the day, when you think about your own economics and your own like ability to innovate and your own ability to like go deeper in terms of what you can do with your products, and ultimately what forms of capital deployment you can provide for return on capital for your customers. I mean, do all roads lead like the highest growth fintechs to become banks, right? We're facing this right now with Circle, where we're being, in a sense, compelled as a stablecoin issuer to become a form of national bank. And I'm just curious, do you believe that it's possible for fintechs to both become banks or have banks, however you want to talk about it, be a bank holding company, and compete, as you just described, on the basis of just like speed, and doing all these things, and just like philosophically, how do you think about that set of issues, especially over the long run?
It's fascinating. So it's and I feel like I have a funny purview to it, in that like the last company that we started was bought by Capital in North America. It was in the consumer bank regulated entity. Today, Ramp, is not a bank. We don't store money, and it's not something we do. And I'll go through a couple of sides of it, which is one. I think what Jamie Dimon is saying in particular, I think is really oriented. Again, not a super expert. I think this is oriented at banks like Chime, and others where they're storing money. They might be storing a lot. And for the same transactions, JP Morgan could be making 10 cents per swipe on a regulated debit transaction, whereas Chime could be making 1.5% or 2%. And I think in many ways that is both true, that there is an unfair advantage. I'd also say some of it was actually explicitly by design. It strikes me it's easy to forget, but that was the intent of the too big to fail regulation. Was actually that smaller banks would be propped up and have a way of competing, in that new and alternative structures which would be able to supplant, such that you didn't see further concentration. And so, well, I think it certainly doesn't feel good. I'm sure to be a large bank and be working just as hard, if not some cases more, and make less. I do think there was some regulator intent in doing that, just as a third party, bystander in that. Next, what I would say is that, I think in some ways, the effect of regulate, like, I think it's important to, like, there are many cases, I think, when regulators can be really right, where, making sure that people's, it's particularly if you're storing money, people's livelihood, they really understand the nature of the asset that they're getting into, and also that, no matter what happens in the next case, that, you wake up the next day, crisis happens, your money is still there and it's still good, I think is an important service for regulators to place. And so I actually think that it's hard. I actually think a lot of the hairiest arguments start to come in, where it's like, like, either you have to go with regulators or you have to go outside of it, and it's this either or kind of world. Where I think that, at least for me, I do think that it should be possible to carve this, and I'll give you some analogies in some of the debates that we got into at Capital One, where even in computing and in security, generally around security is where a lot of these issues would start to come up, in past experiences, where people would say, look, like, so there was a governance organization at this bank, because they said, well, the regulators are going to look at us, and so we need to make sure that prior to the shipment of any new release to the website, there had to be a legal review, there had to be compliance review, there had to be marketing review, there had to be, it was effectively 3 months of reviews for any new feature to be shipped at least at my team at Capital One. We said, well, if I'm updating interest rates, or if I'm, changing the way that money is held, and it could have this effect, no problem. Like, that makes sense to me. We should be careful about that. But if we're updating a button on the website to change the color, surely we don't need 8 councils, to review this. And right. I think in many ways, like a lot of where I think many companies get just crushed and stop moving slowly, is that all decisions are regulated with the same weight and same rigor that truly the important one needs to be. And I think one of the wonders of AWS, but also too, even of cryptocurrency in general, is effectively you can compartmentalize. You can have different protocols apply to different parts of the infrastructure, and I think that kind of paradigm is the right way to approach this. Where even in running the companies, if you want to hold funds, that could be great. Do it. Approach that with care, and you could talk about even divisions within that. But trying to explicitly design your own organization or shipping infrastructures and like practices to sort of understand, like, where is there really risk, where is there not, isolate, think through, so you can actually both take care of really these important regulatory concerns, but also ship fast. And so, how do you think about it, Jeremy?
Yeah, I mean, I think it's very, very, very similar, and I think obviously the space that we're in is we've always been in sort of these gray areas, and there's just all these technologies that are emerging that regulators haven't had really any specific let's just say rules around, and so it's interesting. It's like you want to interface with DeFi. Well, what does that mean? Like, there's never been anything like, it's completely mind blowing. Like, oh, there's a decentralized capital market. How do you legally interact with that? And so I think just at a high level, it's that sort of enterprise risk framework, and sort of how do you empower a product organization to be able to drive towards decisions and have real risk weighting against, like, what is something within a framework that really is, if it's rated this way, how do you take the time to really analyze it and mitigate it and so on, versus, smaller scale things and balancing that out. So look, it's like the heart of the issue for fintechs is sort of that balancing risk and enabling high velocity and everything else. But it's something we all struggle with, all the time. But very cool. Well, so Eric, this has obviously been a really great conversation, and super appreciate it. I will just note for listeners in the next episode of the Money Movement, we're going to be joined by Scott Lawin, CEO at Candy Digital, to discuss their work in sports NFTs, why they started with Major League Baseball, and the current state of the NFT market. With that, Eric, I want to thank you again for joining us today.
Yeah, thanks so much for having me. I really enjoyed this.